Is your dream of owning a home in the US becoming a nightmare because of rising inflation? How is this surge affecting the housing market? Let's take a deep dive into this. We're currently witnessing a unique blend of circumstances in the US housing market. On one hand, there are the falling mortgage rates, an enticing factor for potential buyers. But on the other hand, we have a looming specter that's casting an ominous shadow over these attractive rates: the surge of inflation. Just to put things into perspective, let's reference a recent CNN article. It revealed that despite a third consecutive week of falling rates, the 30-year fixed-rate mortgage is still significantly higher than it was a year ago. This is largely due to the Federal Reserve's interest rate hikes aimed at combating inflation. However, the hints of a potential slowdown in these hikes have been well received by investors, leading to a slight relief in rates. Now, turning our attention to another report by Business Insider, we see that mortgage applications have hit a 22-year low. This is mainly due to inflation fears impacting the housing sector, leading to economic uncertainty, affordability challenges, and higher borrowing costs. This surge in inflation and the subsequent increase in mortgage rates have created a paradox of sorts. While the lower rates are drawing buyers back to the market, the inflation-induced high rates are pushing them away, and this tug-of-war is putting a strain on the US housing market. So what we're witnessing is not just a shift in numbers, it's a shift in the very dynamics of the housing market. This surge in inflation is not just a statistical inconvenience, it's a tangible force that's shaking the foundations of homeownership. Inflation, as it seems, has turned from a silent lurker to a loud disruptor in the housing market. But how exactly does this play out? Stay tuned as we delve deeper into this inflation conundrum in the next scene. Let us delve into these news articles and decipher the numbers they present. Starting with a report from CNN, we see that Freddie Mac's mortgage rates fell for the third week in a row. The 30-year fixed-rate mortgage averaged 6.49% in the week ending December 1st. This is down from 6.58% the previous week, yet significantly higher than the 3.11% rate from a year ago. This downward trend, while seemingly good news, is occurring in an environment where the Federal Reserve's interest rate hikes have been causing mortgage rates to rise throughout most of 2022. However, recent reports suggesting a peak in inflation have prompted a brief respite, causing rates to drop. Despite this, the forecast for 2023 suggests elevated housing costs and a growing inventory of homes for sale. Now let's turn our attention to the Business Insider article. Here we find that mortgage applications have hit a 22-year low, dropping 6.3% due to inflation fears impacting the housing sector. Furthermore, mortgage refinancing has fallen to its lowest levels since 2000. Higher borrowing costs, with mortgage rates doubling to nearly 6% for 30-year fixed-rate mortgages, have contributed to this decline. The surge in rates was influenced by a 9.1% increase in June inflation, leading to expectations of a 75-point rate hike by the Federal Reserve. This is a clear sign of an inflation surge that the Federal Reserve does not seem to have under control. These articles highlight a common thread: the rising inflation and its detrimental impact on the housing market. Falling mortgage applications and rising interest rates are just two indicators of the economic uncertainty and affordability challenges faced by many. These figures paint a rather grim picture of the housing market, don't they? But what do they mean for the average homeowner or prospective buyer? The rising inflation has a direct and significant impact on homeowners and prospective buyers. But what does this impact look like? As inflation continues to surge, its effects on the housing market are becoming increasingly noticeable. For homeowners, one of the most significant effects is the rise in mortgage rates. When inflation increases, lenders often raise interest rates to maintain the real rate of return on their loans. This is reflected in the mortgage rates, which have been on an upward trajectory, making it more expensive for homeowners to borrow money. A report from CNN in December of 2022 noted a drop in mortgage rates after they had been rising throughout most of the year. However, even with this relief, the rates were still significantly higher than they were a year prior. This means that homeowners who have variable rate mortgages or who are looking to refinance are facing higher costs. But it's not just existing homeowners who are feeling the pinch. Prospective buyers are also finding it more difficult to enter the housing market. Affordability is a major concern, especially as house prices continue to rise. As Business Insider noted in July of 2022, mortgage applications hit a 22-year low, reflecting the economic uncertainty, high inflation and affordability challenges facing potential buyers. The increase in borrowing costs, combined with surging house prices, is creating a perfect storm that is making it increasingly difficult for many people to own homes. This is particularly concerning as home ownership has long been seen as a key aspect of the American dream and a pathway to wealth creation. However, it's not just about dollars and cents. The emotional toll of this situation can't be underestimated. The uncertainty and stress of not knowing if you can afford to keep your home or if you'll be able to buy a home in the future can have significant psychological effects. The dream of owning a home, it seems, is becoming increasingly elusive for many. But why is this happening? The Federal Reserve carries a substantial weight in controlling inflation, yet many wonder, is it doing enough? This sentiment is particularly shared by homeowners who are grappling with climbing mortgage rates. The Federal Reserve, more commonly known as the Fed, serves as the US central bank. Tasked with executing monetary policy to promote economic stability, one of its principal functions is to regulate inflation. Theoretically, the Fed increases interest rates to temper economic expansion and control inflation. Looking at recent history, in 2022, the Fed hiked interest rates in an attempt to combat inflation. The result? Mortgage rates rose consistently through the year. By December, the 30-year fixed-rate mortgage averaged a staggering 6.49%, an alarming leap from the 3.11% rate from the previous year. Yet, these actions did not seem to halt inflating prices. In fact, inflation appeared to reach a climax, causing mortgage rates to decrease, a clear indication that the Fed's maneuvers were not yielding the expected results. Fed Chairman Jerome Powell even suggested a possible deceleration in rate hikes, a decision welcomed by investors. But the burning question remains, are these efforts sufficient? Many critics opine that the Fed has been too sluggish in reacting to the inflation spike. This is distinctly felt in the mortgage market, a sector that saw mortgage applications plunge to a 22-year low and mortgage refinancing reaching its lowest since the beginning of the millennium. The effects on homeowners and prospective buyers are palpable and unsettling. The actions or lack thereof of the Federal Reserve have undeniably contributed to the current turbulent housing market. Transitioning to the present day, 2024 news articles reveal a similar trend. According to a Wall Street Journal report, mortgage rates to remain high and inflation seems to be persistent, casting a shadow over the effectiveness of the Fed's measures. The future of the housing market still remains uncertain. The future of the US housing market in the face of rising inflation is uncertain, but what can we expect? Taking a gander into the crystal ball of economic forecasts, we see a landscape of elevated housing costs, but also a growing inventory of homes for sale. This particular prediction comes from Freddie Mac's report, which suggests that although financial pressures persist, buyers may find themselves with more options and potentially better bargaining positions. However, the affordability of homes is still a pressing issue, with mortgage rates hovering around 6.49%. As we've earlier discussed, these rates are significantly higher than the 3.11% rate we saw a year ago. This drastic increase, driven by the Federal Reserve's measures to combat inflation, has added to the cost of home ownership and deterred potential buyers. Mortgage applications have hit a 22-year low, according to an article from Business Insider. This drop in demand is a clear indication of the challenges facing the housing market. High inflation, economic uncertainty, and affordability issues are leading to fewer people applying for mortgages. If these conditions persist, we might see a significant slowdown in the housing market. But the economy is fluid, ever-changing. The recent reports suggesting a peak in inflation have caused rates to drop, sparking a glimmer of hope. The Federal Reserve's chairman, Jerome Powell, has hinted at a potential slowdown in rate hikes, a move that was well received by investors. The future of the US housing market is not set in stone. It is influenced by a myriad of factors, including government policies, economic conditions, and consumer sentiment. Rising inflation is certainly a challenge, but it's not the only variable in play. We are in a time of uncertainty, but as always, knowledge is power. The future may seem daunting, but understanding the situation is the first step towards navigating it. Stay informed, stay prepared,